Sonlin and Herwig Konings are founding partners of Security Token Group. All opinions expressed by them or guests on this podcast are solely their opinions and do not represent the views of Security Token Group or its subsidiaries. You should not take any opinion expressed on the show as a specific inducement to make a particular investment or follow any investment strategy. This podcast is for informational purposes only.
Hello, everyone, and thanks for tuning in to this week's episode of the Security Token Show. We're coming to you from our studio in sunny Miami, Florida, and I'm your host, Herwig, and I'm joined by my co-host and business partner, Kyle Sonlin. So for those of you who are new listeners, you should know that each week the show starts out by covering last week's industry news, followed by the newest security token offerings, and a breakdown of the secondary market trading report.
That's right. And then we finish off the show with our weekly main topic discussion, which this week is the stimulating topic of security token liquidity, specifically talking about the 3 layers of liquidity, and we're going to dive into that later in the show. But of course, we can't get started without first doing our Company of the Week awards, where we award 2 companies of the week for making the biggest moves in the industry. So who was your pick for this week, Herwig?
Well, this one caught my attention because the phrase "eat your own dog food" really hits home for me. So SEBA Bank in Switzerland is getting my company of the week for tokenizing their own Series B financing round of $22.5 million. So they actually completed that back in December last year. But the company offers an end-to-end tokenization solution in Switzerland, including custody, issuance, and a trading platform. And they did announce a partnership with TokenSoft last year. So presumably that's who they partnered with for their ERC20 token for the Series B equity. So for filling up on their own dog food, listeners, SEBA Bank wins my company of the week.
That's amazing. That's really, really exciting. Shout out to SEBA Bank for the tremendous advancements there. Huge news, definitely company of the week worthy.
Yeah, and always good to have a huge financing round to boot. So good luck with that, SEBA. Who do you got, Kyle?
My company of the week this week is Konings Investment Bank, which is a leading investment bank based out of Malaysia, who is now active in the security token space. So the firm has invested in Tokenized Exchange, which is one of 3 operators in Malaysia with a crypto license to actually launch security tokens in the region. And Tokenized Exchange, that's tokenized, Tokenize, and then Exchange, just Exchange, was initially launched in Singapore by founder Hong Ki-yu in 2018, and it has actually a customer base of over 100,000 users already. And he actually noted in the press release that, quote, their interest in digital assets goes beyond Bitcoin and other commonly traded cryptocurrencies. They believe that the technology behind digital assets is very powerful, and the emergence of digital assets in the future is inevitable. They are hopeful that the fundraising through tokenization of businesses and assets will be a significant part of the capital markets in the future for Malaysia. He believes that through tokenized Malaysia, they can be a key player in the digital capital market space in Malaysia, end quote. And so this is tremendous. This guy, Hong Ki, does seem to be a forward thinking on this front, and Konings for investing in this business and helping them scale their operations in Malaysia is just tremendous. So for all of those innovative investments that they've made in companies like this, as well as other e-commerce companies they've made in the space recently, and their forward thinking strategy on security tokens, Konings Investment Bank is my company of the week for this week.
Well, it makes a lot of sense. There's only a few operators out in Malaysia, but Asia has a huge presence in the digital security space, and it sounds like this bank is making their bet with Tokenized Malaysia, and I'm sure they're going to bring their resources and pipeline and investors and network with them. So that's great news. Congratulations.
I think they've got $890 million in assets under management. So this is no small bank, especially if you're based out of Malaysia. That's a huge size.
That's huge.
Fantastic work and
Well, that's awesome.
Yeah.
Let's get into the news. Before I do, of course, I want you all to know that our articles, everything that we cover on the show, really, it's all sourced from stomarket.com/news. But it's also available for reference in the about description of wherever you're listening to the podcast. Or you can actually go to the Medium blog, the Security Token Show Medium blog. Whenever you want, you can always dig into these articles for yourself. So let's get into it. We don't have too much, to cover. But there has been a roar lately with Luxembourg, Germany, and Switzerland all passing or implementing security token regulations to ease their usage for the industry. That's great news, and hopefully we can say the same for things at home for Kyle and I here in the U.S., where we may have some leaked rumors that no changes will happen to the $5 million raise limit cap increase for regulation crowdfunding. So now it's not official, so I won't be too quick to celebrate it, but it came from a pretty trusted source. But the same is not true for the ICO issuers behind the NAC Foundation, which were the latest target of the SEC, to get an update on their case with the judge, actually in their case in California, speaking in favor of the SEC and throwing out any potential of a dismissal for the case, that the SEC has taken on them. So more interestingly is what Judge Richard Seaborg said in regards to the Howey test, which is, of course, the universal test in the United States used as precedent for defining what securities are. There are multiple prongs which satisfy this, and we cover this in detail on episode 62 of the show if you want to hear, you want to learn more about that in detail, of course, but it's actually on YouTube. But specifically, he said, according to the National Review article, that with respect to the common enterprise element, Judge Seaborg noted that, quote, a common enterprise exists where the investment scheme involves either horizontal commonality or strict vertical commonality, and further noted that vertical commonality may be established by showing that the fortunes of the investors are linked with those of the promoters. So based on that standard, Judge Seaborg found that it was quite plausible and indeed probable that strict vertical commonality existed between the defendants and the ICO participants. So this was because the fortunes of the ICO participants, as measured by either the trading value of their ABTC tokens or the future trading value of the AML Bitcoin, were linked to the fortune of the defendants, as measured by the trading value of their ABC tokens, and of course their future trading value of the AML Bitcoin, which was the project, and general success of the enterprise, as they call it. So, and the judge also cited that the Telegram case, where the court held that the SEC had made a, quote, substantial showing of strict vertical commonality. And so in this case, the NAC defendants have maybe gone even beyond that. So as such, Judge Seaborg held that the NAC defendants' financial fortunes, were even more strongly tied to the ICO participants, and therefore there's definitely no shot of them getting out of this. This is just the SEC justice hammer clobbering away. We can expect a settlement for this one pretty soon, I think. And it's also worth noting that SBI, which is a major investment bank and security token player in Japan, expanded its crypto lending services to support Ripple's XRP. So, which may have, many have shied away from, doing this, given that the SEC trial against Ripple alleging that XRP is a security. So now, given SBI is already a regulated investment bank in Japan, it's maybe not such a big deal for SBI if it were to become the case that XRP is deemed a security in Japan. Anyway, moving into security token company announcements, we start off with what looks like another security token marketplace coming to the U.S. as the GSX Group out of Gibraltar has announced a partnership with Document Security Systems and CoinStreet Partners to develop a joint venture focused on what they call a global digital exchange ecosystem for the issuance, trading, and settlement of tokenized securities. So, of course, in order to do so, they will need to acquire and receive approval for an ATS license from FINRA, which they are reportedly actively pursuing. So that means we can hopefully expect yet another player in the United States very soon. And GSX's Stacks issuance technology should complement nicely with the CoinStreet and DSS's 4+ years of security token experience in the space. And last week, also, Singapore digital securities marketplace ECXX Global has announced a partnership with UOB Kay Hian, which to provide security token offerings. So, according to the Crowdfund Insider article, UOB Kay Hian, which is a global billion-dollar financial services company in Singapore, well, they are excited about security tokens and ESX's role and success within the industry already. So they claim to have a strong pipeline of STOs that will be launching on ECXX in the coming months. So that's exciting stuff for Singapore as it continues to lead Asia and possibly the world in security token growth. And T0 is sticking true to its word about announcing partnership growth last week to grow the overall platforms on the assets with the goal there. So back-to-back announcements. T0 announced issuance platform support for both Vertalo and TokenSoft, though Vertalo was admittedly first. And this means TokenSoft issuers and Vertalo issuers who get approved to list their securities on T0 won't need to change technology vendors, and that's likely not through any kind of a technical integration, but likely because T0 will omnibus custody all the security tokens while you trade on their platform. So I can't say that's the case for sure, because personally I'd love to see all transactions occur on the blockchain that we can track. But this is also the easiest way to start a partnership like this, so I understand. Hopefully all this means, we will really see is that either Vertalo or TokenSoft issuers will soon be listing on T0. And Merge Exchange has partnered up with RedBlock in a strategic collaboration to promote digital securities adoption, which is a relationship we have with Chinese-based RedBlock Capital as well. So Merge's head of strategy, Jim Needham, said, quote, RedBlock are successful pioneers of a new business model, and digital securities technology is the very DNA of their business. They bring capital markets expertise, technology expertise, and investment expertise together under one roof, which makes them a dream partner. So they share our global outlook and our roadmaps and are very well aligned. So we are delighted at the prospects of working together, end quote. So, and it's true, both do have very global outlooks for the industry, and as do we. So we're excited to be working with both firms already. So congratulations to these two new lovebirds. Three's a party. And Canadian security token company Finhaven has announced some new talented individuals to grow and scale their digital securities technology team. So Farouk Malou and Jason Burrows bring over 20 years of experience in investment banking, M&A, and corporate development, as well as technology experience. So Farouk, Finhaven's new managing director of investment banking, previously worked for both Citigroup and Canada's CIBC World Markets. And Jason, Finhaven's new chief technology officer, has over 25 years of technology development under his belt, previously serving as CTO and co-founder of Pounce Web Solutions. So two pivotal roles for a security token company and two veterans with lots of experience to build the company. Good luck to Finhaven and congratulations on your new assignments. And now let's wrap up this segment with the latest resources and opinion articles. We start off with our very own report of the Q4 infrastructure investment into security token companies for 2020. So some highlights include the fact that an astonishing $87 million was invested to close the year. And that brings us to a total of $190 million for the year actually combined. And so a significant increase after the industry was struck with the pandemic and fundraising nearly halted, where we only saw $6 million invested in the second quarter. Now, given that we've already seen HQLAX, Sony and others combined having raised over $40 million now halfway through this quarter, I think it's a strong sign we'll continue to keep pace with last quarter. So, which is the expectation as companies mature in this industry and they prove their business models of security tokens, and they then can receive growth capital, which of course comes in larger sizes. And for those of you following along, that actually means since we've started tracking the space in 2018, we've now exceeded $1 billion invested in security tokens. That's absolutely hype. This industry is definitely poised for trillions, right?
Great work from the team at Security Token Advisors.
Thank you, Kyle. And don't just take my word for it. BNP Paribas, Liquify, and Chartered Alternative Investment Analysis Association, the Kaya branded, together, they banded together to create a 50-plus page research paper on the tokenization of alternative investments. So it features everything from fractionalization, broadening ownership access, to the benefits of digitization for capital markets. So this is a great primer for anyone looking to get started in this industry. They did an awesome job, BNP, Kaya, and Liquify. This is quality educational content. And Polymath's Graham Moore was in Fortune last week, and now the Chief Product Officer, Thomas Borrell, is in the news in the FinTech Times this time, talking about going beyond liquidity when it comes to tokenization. So he focuses on the fact that they can unlock new investment opportunities and create more efficiencies with reduced risk. So check out his outlook for the security token industry if you're curious. And we also saw an opinion article on the Commercial Observer featuring Richard Johnson of Texture Capital and Derek Boyron, the CEO of New York-based Relio. So they said that COVID has spurred tokenization via blockchain technology and specifically in the commercial real estate sector. So if you're in that space, definitely go check this one out. And finally, we can end on the new weekly series by Peter Gaffney, who started the Tokenize This series, usually out on Wednesdays. And in the fourth installment, Peter covers tokenizing the business of sports betting syndicates. So another novel concept, I'd say, in the series. So the reading is never dull here. And in this case, he reviews the idea of a professional sports gambler raising capital so that the retail investors can get exposure to their profits while providing more capital to the sports gambler to win bigger. So he also shares a cool idea that once you have tokenized bets, you can go ahead and say, convert your winnings from the Super Bowl, go ahead and transfer those into the backing gambler for March Madness. So that's great stuff, Peter. Check it out on Medium, folks. And that's a full rundown of last week's news. So Kyle, Do we got any events coming up?
Well, Herwig, we have a huge event coming up this week that I have the pleasure of announcing. It's coming up this Thursday. And I'm talking about the very first Security Token Clubhouse event. We're hosting a discussion on Clubhouse, breaking down all of the news and content that we covered here on the show, as well as digging into that main topic with some other industry experts and entrepreneurs in the space. So it's going to be a really fun time, and this is actually our first, but certainly not last, foray into the Clubhouse scene, as we plan to do a weekly show on Thursdays to do a breakout session about the podcast, covering the episode, and to bring that industry together. So if you want to listen or participate, please come hang out with us on Thursday at 5 p.m. Eastern Time on Clubhouse. And if you need an invite to that app, it's only iOS, so it's only for Apple devices. But if you're not on Clubhouse yet, it's an awesome app, great way to connect with people. Reach out to me or Herwig and we'll hook it up. So submit your questions or tune in on Thursday, 5 p.m. for a great time. And that's about it for events and webinars this week. Remember that you can submit any industry news or events on stomarket.com/news. So definitely go there and we'll cover it on the show. But going into some new STO updates, we actually didn't have any new STOs this week, but we do have a great market update section. So we're going to dig right into it. And the first update comes from Aspen Coin, which is the tokenized hotel property trading on T0. And the firm publishes monthly updates about the company's performance. And I'm actually excited to break that down here. But we have more than just its company performance that we're going to break down today. Kicking off with the firm's December update and 2020 year in review, it wasn't super positive from a financial perspective. The disclosure confirmed what you may have been suspecting about hotels, and that's that hotel occupancy has struggled dramatically since the county, specifically in Aspen, was distinguished a high risk for COVID. Understandably, hospitality has struggled across the board worldwide, and unfortunately, the St. Regis Resort was not immune to the shrinkage in the market. December 2020 closed out with a total revenue of $3.8 million, which was about 25% lower than their forecasted revenue of $4.7 million, and about 43% lower than the $6.7 million achieved just last year in December 2019. As they note in the document, the result is very likely explained by a new set of restrictions that are hitting the Pitkin County, which is where Aspen is, and that news follows a trend that has been observed in the whole city of Aspen. I think it's no indoor dining, a lot of these kinds of things that we're seeing around the world, which certainly you'd expect would impact hospitality. Looking at the company's full financials for the year of 2020, though, the resort closed out at about $33.6 million US dollars, which was above their forecasts when anticipating the effects of COVID would have on their business, but it was significantly lower than 2019, where it was about 33% decrease year over year. One strong positive from the report, however, was that the hotel actually outperformed 2019 in September, October, and November, suggesting that it's positioned to bounce back strong once the pandemic is contained. They also noted that they issued a 6.667% dividend to shareholders in March 2020, which was the third distribution from the company, which was news to me and actually a huge deal, to be honest with you. It's very awesome stuff from the firm here, and it helps validate the value proposition of the ASPD token. Certainly, you'd think that even if the equity value doesn't change, a 6.5% or 6 2/3% dividend is a very strong dividend from any kind of asset. So that's tremendous. Regarding future distributions, the firm did note its intentions to continue to do distribution payments in the future, but not until COVID is, the storm has been weathered, because they're still hemorrhaging cash on that front. But I will certainly get you the updates on that and what that schedule looks like as soon as they release it. There were two other small updates from Aspen Digital that were also important to mention as well. The first one is that the company announced that Aspen Coin can now be used as loan collateral through BlockFi, allowing what is, as far as I know, the first opportunity to get leverage on your security token trades, which is very cool and definitely something that we should cover in a main topic or something like that in the future. And finally, the firm laid out some details for its new owner benefit program, which aims to provide shareholders with benefits surrounding the actual underlying asset of the St. Regis Hotel. So in addition to graduated discounts on rooms at the hotel based off of how much of the Aspen Coin asset you owned, the St. Regis Aspen Resort will offer perks like test driving Lamborghini sports cars and exclusive access to luxury cosmetic products, including a private session with the cosmetic founder, Dr. Barbara Sturm. So all in all, it was a tremendous update from Aspen Digital. I commend the firm for being so transparent with their financials, as well as forward thinking regarding their investor relations strategies. So you can find that disclosure on the firm's listing page on tzero.com. And I certainly would recommend you checking out the financials if you're interested in investing. Congratulations to Aspen Coin. Keep it up.
If you happen to own some of these tokens on tZERO, we do not, but this is definitely, as Kyle said, very great information. Go check out this report for yourself. This is great.
Yeah, it's pretty in depth. It's like I think 8 or 9 pages at least, and again they do it monthly, so you can really keep up to date with that. Our second update is actually a correction to a previous set of comments I made on the show over the last few months. Originally corrected by a member of our community known as Stanley STO. I had previously thought that Solid Block was assisting in the issuance of Aspen Coin's security token offering, but it does seem like instead that the project migrated from Solid Block's platform and actually issued through Securitize. So it seems like there's maybe a falling out between the two firms according to some articles and some research that I did, and Securitize was the issuance platform that brought the ASPD token to market, not Solid Block. However, Solid Block has confirmed to be issuing real estate tokens through the INX platform coming very soon. So hopefully in the coming months, we'll be able to compare the different issued assets to see what they learned from this experience. So thanks for the feedback, Stanley. And if anyone is listening and would like to offer clarifications or additional context to anything we cover on the show, please email us or find either of us on social media to give your feedback. Or you could just join the Clubhouse session, the breakout conversation that we're going to have on Thursday, where we break down all of our main topics and all this news, 5 p.m. Eastern time, and give us some feedback there. In the next market update, we have 2 listed Realty tokens that are new that are now tracked on stomarket.com. So please welcome 15643 Liberal Street as well as 18900 Manfield Street to the market. Officially trading on Uniswap, it looks like these tokens have actually been live for multiple months now, but for some reason I actually couldn't find any historical record of these assets on Uniswap's data platform until just recently. And I was actually had to do it via Etherscan, where they were not live from before. I don't know. There were some weird issues, but hey, better late than never. These 2 properties fall right in that same 70K market cap range as many of the other Realty properties, and they also pay a very similar dividend range. But nonetheless, it's about $150,000 in additional market cap and 2 new tokenized properties that you can now invest in. So that brings us up to a total of 11 Realty properties that are trading and 13 total assets on Uniswap, which really shows the power of that decentralized exchange. And our final market update comes from us at Security Token Market, who just published our monthly market report, this time kicking off January 2021. Fortunately, after a tough stretch there to close out 2020, the markets have been pumping. In the month of January, the total market cap was up about 35%, and trading volumes were up over 140% from what we saw in December. That is what I'm talking about, listeners. I also have some trading highlights for you on that, starting with our top performers over the last month. We had Protos, which killed it, up 400%, as well as tZERO up 51%, Overstock up 49%. So those were the real winners. Certainly tZERO and Overstock do significant volume. Protos, it was pretty low volumes, but the price again did change. So therefore, they were the winner of this month for sure. But we saw tremendous growth from tZERO and Overstock and tremendous volume there as well. And then moving on to the worst performers, we had Spice VC, which took a 30% drop, as well as a couple Realty properties, which were down double digits in percentages. But again, as we've covered with all 3 of those tokens, they actually were up year to date. So, nothing really to be that afraid of there. And then there was a new section that we added this month, which was the token with the highest volume on each exchange or marketplace. So as we look at tZERO, Overstock was the real winner there with 5.3 million in trading volume in just January. Blockchain Capital had about 41,000 through Open Finance. Fullerton Avenue on Uniswap from Realty had about 27,000. And then we had Curzio Equity on Merge that did just about 22,000 in trading volume. So all that stuff's fantastic. And just a reminder that this month's market report debuted on our Substack newsletter, which you can view and sign up on newsletter.stomarket.com for free. You'll get email updates on all of our newest publications, as well as podcast episodes and other great content. You definitely got to check that one out.
Wow, gotta love that, huh? An all-time high.
And so then moving into the market cap, the market cap was up this week to 644 million. So we're really nearing that all-time high, as you said, and it's another huge week for the market, led by Overstock, which was up 31%, closing in on $100 per share after hitting lows last month of nearly $40. T0 was also up 11%, and BCAP rose again, up nearly 6% to $6 a share. It really wasn't too long ago that it was trading under $2, and now it's up 3 times that. So many of the Real T tokens did not trade this week either, which again makes me a little bit suspicious that they may have upgraded to the Uniswap V2 liquidity pool, which we saw Mount Pelerin do a few months back, but unfortunately I haven't yet been able to locate the trading data for these new pools, and I'm working hard to either clarify that or get that data as soon as I can. If anybody has any suggestions or advice on pulling some of that data from Uniswap, please hit me up, because I can't find it on their platform, and going through the Etherscan data, we're all fully caught up, all to date, so potentially it's just low trading volumes. However, that's what you're going to get with for now. I've reached out to a bunch of those different people, including Realty and Uniswap, and I'll keep you updated if I hear from them.
Better you get that data than never, like you said. So keep on trying, Kyle. We know you're doing your best on that. But so close, you said, to an all-time high. That's exciting. I think we're almost there. I think maybe we'll break it at least in next week's episode.
You
if
have
not
to think.
already by the time we go live.
Yeah, we're on that trend, and it's just so close. I really can't help but feel like it's nothing up from here. So that's all fantastic. And with that, Herwig, I think let's dive into the topic for today, for the main topic, which is liquidity. And you described that there were 3 types of liquidity in an article that you published all the way back in January 2019. And that was titled Debunking the Myths of Liquidity, in which you argued that security tokens don't necessarily equate to liquidity. And I'd love to hear more.
Definitely, Kyle. Yeah, I definitely remember that one. Security tokens were a huge point of interest in the crypto industry back then, but the crypto industry, they thrive on liquidity with their exchanges, and many were seeing security tokens as a way, create instant liquidity for an asset or a security, which is just not the case. The reality is that digging an asset does make it a lot easier, but it certainly goes far from instant. But before I define what I call the 3 layers of liquidity, Kyle, I think people have a different interpretation of the term, especially all different types of listeners on the show here. So how would you define liquidity to them?
So liquidity is simply an asset's ability to be converted into cash, right? So dollars are really liquid because everyone has them, and that's really what we're talking about from a base standpoint. How quickly you can convert that into fiat currency is really how we define liquidity. So private companies, for example, are very illiquid because it's very difficult to transition that into US dollars, and really because they live in an outdated capital market infrastructure that makes it very difficult to buy or sell.
Well said. So many asset issuers were looking to security tokens to create some sort of an instant liquidity solution, which is just simply not the case. I think the term supply and demand comes to mind, with emphasis on the part of demand since the supply already existed. So creating demand is a function of many different factors, I'd say. Liquidity errs more on the combination of demand and the ease of access to the supply, I'd also say. So security tokens make it dramatically easier to implement access to the supply and to create demand via numerous mechanics. But of course, we are assuming in all of this that there's some level of value and or growth potential to the asset itself, right?
Yeah, exactly. So what are those 3 layers of liquidity that you're looking to describe? I mean, are there different ways to implement liquidity?
Not quite. It's actually a little bit more like about the types of liquidity channels, if you will. So there are 3 different types of transactions that all involve the buying and selling of a security token or an asset in general, really. So there's actually maybe a bonus 4th layer. I don't know. We don't really know where it fits, but you'll have to tell me your thoughts when we get to it, Kyle.
Yeah, absolutely. So how about you just dig right into it and break it down for our listeners?
All right, let's do it. So the first layer is the issuer itself. So the second is peer-to-peer, and the third is secondary markets. So let me explain each in a little more detail. The issuer layer I describe, as any sale with the counterparty being the original issuer of the tokens. So the issuer has more flexibility than investors, employees, or even brokers. They can offer buybacks to the purchaser, offer loans like Reno does with their real estate tokens in the first year, or they can even, offer programmatic exchange rates for perhaps different token types, meaning that, someone could go and exchange their securities for Bitcoin or US dollar tokens, or maybe another class of shares with the issuer. In essence, instance, if you're able to buy a security token and you can always sell it back to the issuer at fair market value, then you've got yourself a pretty liquid token because you could go and sell it back to the issuer at any time, regardless of lockup periods as well, by the way.
Yeah, that's a nice touch, and it goes to show the freedom that you have as an issuer to create liquidity for your asset. And now I think we should take maybe a quick pause here and reiterate the fact that neither Herwig nor myself are securities attorneys. So definitely verify all of this with your legal counsel. But to me, it sounds like as an issuer, you have the most possibilities of creating benefits for your investors, as you said, via a loan or buyback or similar program. So I think many issuers jump to the idea that you need to immediately list on an exchange somewhere, and that's just simply not the case.
Yeah, absolutely right, Kyle. It's often not the first consideration, and I think that's because before security tokens, implementing such benefits to investors was just extremely difficult to manage. Before, it was common that maybe you might actually have penalties to redeem or sell your interest back to the issuer. So now, thanks to smart contracts, it's really easy to engage in securities transactions with your investors. So letting them stake their tokens as collateral for a loan or instantly trade them in for some US dollar coins is, actually dead simple and much cheaper to administrate. So, and that also offers us a kind of nice segue point into the second layer, which is often also considered an afterthought, I think, to investors, but it's actually a revolutionary concept, I'd say. So investors who previously held what are typically considered illiquid assets had to go through many hoops to sell it to someone else, typically sometimes requiring approval from the company and legal documents to also be drafted up. So now, thanks again to the benefits of self-custody for security tokens, they can be transferred peer-to-peer between qualified investors while updating the issuer's ownership chart automatically. So this presents two new liquidity strategies using this channel. The first is that an investor, they can now have liquidity via their own network, something that might be used as a way to recoup some of their initial investments or maybe even split the risk of the investment, or something to sell to other funds or investors in a much easier fashion. And when things become easier to do, they tend to be done more frequently. So, which leads to the second strategy, which is OTC desks, otherwise known as over-the-counter traders. So, enabling funds and asset managers and market makers to support your security token will definitely increase the access for peer-to-peer transactions because the network effect just grows a lot bigger. So, let's give an example. An investor in Kansas City lost all his money on the Super Bowl, who is now trying to sell his security tokens because he needs money to someone else in his network. But it's useless because when everyone else in his Kansas City network, they've all lost money on the Super Bowl, so no one's got any ability to buy or sell there. But if our Kansas City investor had an OTC desk, that was actively trading the stock because they are trading it across the country or via a network peer-to-peer thanks to security token technology, well, then the investor may be able to find a buyer.
A timely example, Herwig. I imagine Kansas City investors lost a lot of money over the weekend, but basically, as I see it, you're saying that illiquid securities now have less friction when performing over-the-counter or peer-to-peer trades, and therefore may now be traded more, which increases the potential demand for the asset, given that it's easier to acquire and manage your trade back.
Yeah, that's exactly right. And this works for bigger and more established security tokens, but it will start to happen more and more, and that I have no doubt about. But of course, everyone is looking at the holy grail, the third layer, the secondary market layer. Marketplaces and exchanges, they're secondary players designed to help facilitate securities without taking the risk themselves. We're all familiar with marketplaces like T0 and Open Finance and Archex, but there's actually a full-on exchanges trading like Merge and others being developed around the world.
Yeah, we've got a full list of well over 80, and that we continue to update, and we're going to be fully revamping that. In addition to that, it's really growing like crazy. It's hard to keep track.
Yeah, and then the market is jumping in and to try and meet this anticipated surge of just digital securities, right? So they'll eventually trade on these markets and exchanges. So because they are already operating markets or developing technologies to make operating marketplaces more efficient, investors will aggregate through these mediums of exchange. And then, of course, that's where they'll trade their securities for the best price, given they are typically, the most active at filling orders there. So since security tokens are far easier to support from a technical and administrative perspective, it's expected that a lot of these illiquid assets and securities will leverage these mini stock exchanges of the future, which have superior benefits to Wall Street from a technological and an accessibility perspective. So this strategy strategy tends to be simply, identify a marketplace and a place to list to token there, and then from there, the strategy could evolve maybe to even list on multiple markets to support even further liquidity.
Yeah, no doubt that this is the biggest channel, despite the other two layers being disruptive as new formats of liquidity. But I mean, these are certainly the biggest ones.
So I have to agree with you there for sure. But there is the remaining, question around a potential fourth layer or option, right?
What layer is that? I think I suspect what you're talking about. Jump into it.
Well, as you mentioned, that article was written back in the beginning of 2019, which is a time where the concept of DeFi, decentralized finance, was still in its infancy. So like the year 2016, I'd say, for anyone who was involved in ICOs. Therefore, security tokens, they were definitely not considering solutions like Uniswap to create decentralized automated market maker pools for securities like we've now seen with Realty or Mount Pelerin. So did you guess that correctly there, Kyle?
Yeah. DeFi is absolutely a new phenomenon and an innovation. And it's hard to anticipate what it all still means yet, but early applications and uses are being tested and working incredibly successfully. You can even use security tokens to borrow or stake now, which is fascinating.
Right. So this space moves so fast. Who knows what the future is holding next for us, but where would you put DeFi platforms in the current three layers of liquidity, Kyle? Or would you make it a fourth layer? Is it issuer managed or is it peer-to-peer since it's decentralized?
Yeah, it's definitely a very nuanced answer because the decentralized exchanges of early 2021 may be very different from the DEXs that we see in the future. I think when we consider a platform like Uniswap, which is the best current example, it offers no compliance mechanisms or regulatory standards and requires that the issuer manages that whitelist themselves, which shows that it has many qualities that make it seem like a tech solution for issuer managed liquidity. Essentially, you could look at it like it's a platform to make the issuer managed process easier and more scalable, especially as it's free for any issuer to use. The one caveat with that answer is that the automated market making component, which incentivizes other investors to stake their shares of the asset to provide liquidity for the market while earning fees on each trade. These fees are governed by the community through a governance token, which then starts to make it feel like it should be classified as a liquidity solution outside the issuer's direct control, as the fees and the decisions of the platform could change over time without the approval of the issuer of those listed assets. So I personally think that the classification of what stage a liquidity option should be will depend on the investor and where they're sourced from. So if you look at it from that perspective, in an issuer managed solution, all the investors are directly sourced, serviced, and managed by the issuer themselves. In a peer-to-peer solution, the issuer may not service each trade, but the transactions are still intimate between investors who know each other. And then in the exchange model, the investors don't know each other, and as long as the other side fills the requested buy or sell orders, they frankly don't really care. So at the end of the day, a decentralized exchange falls into that category if we're considering it from an investor's perspective, and if I had to pick a classification, I'd probably go with that one. But you also finally could make the case that it should be totally separate from centralized exchanges, as the permissionless features of a decentralized exchange in combination with the democratized price discovery and the liquidity features are a significant differentiator from the traditional solutions. But I just don't know if those solutions have been developed and fleshed out enough yet to warrant that separate classification yet. But who knows? Maybe in the next few years, as we see innovations on these models, which we absolutely will, it may be a topic to revisit.
Indeed, it's hard to say for certain since most secondary markets are managed by some sort of centralized party at this point. But that's all I've got. I think about the layers of liquidity for security tokens and, I guess assets overall, I suppose.
Well, thanks for breaking it all down, Herwig. And then I think that's all we got for us on the show today. So thanks again for listening, everybody that's stuck around with us through this whole episode. And be sure to catch us every Tuesday when we release a new episode of the Security Token Show. And again, join us, our first ever Clubhouse breakdown. You don't want to miss it. Thursdays, 5 p.m. Eastern Time. You can come see what special guests have to say about the podcast and maybe ask some questions of your own.
If you're not on the Clubhouse app yet, and if you have any questions about any of this, please feel free to reach out to us on LinkedIn or Twitter as well. And be sure to engage with the community at stomarket.com, where you can see all the latest security token pricing data. And it's also where you can submit security token news, events, STOs, and a whole lot more. So thanks for listening, and I hope to catch you next week on Tuesday.